Dietrich is CEO, also Chief Investment Officer, CIO at Fairfax Global Markets. He joins us live from New York. Paul, good to talk to you and appreciate your time. You sound, I know from the notes that I've seen, pretty optimistic about the market for next year based on expectations of what soon-to-be President Trump is going to be able to deliver. Why the optimism?
Well, I think, for the last 8-10 years, we've seen a mediocre 2% GDP growth in the United States. And analysts have valued the market knowing that we were in a 2% GDP growth era. If you look at the tax reforms, the regulatory reforms, and most importantly, the $1 trillion in infrastructure spending that President-elect Trump is proposing, groups like Moody's and other outside analysts have said that this could add, another 1 to 1.5% in the next 2 years to GDP. That gives us, with the current 2%, a 3.5% GDP growth rate. We haven't seen that since John F. Kennedy and Lyndon Johnson and Ronald Reagan. And you value the market at very differently at a 3.5% GDP growth rate than you do at a 2% GDP growth rate.
I get you.
Positive for the market.
Indeed, I get you there. But I mean, look, Paul, the problem is this is all wishful thinking. Whether or not the economy is going to be, or his policies rather, are going to be able to deliver numbers like this for the economy. A lot depends honestly on Congress, doesn't it?
It does, but look at it, we're really diving down into the numbers. And if you look at the infrastructure spending proposals, that literally has bipartisan support. I actually believe more Democrats will vote for the infrastructure spending than Republicans. But it will definitely have majorities in both the House and the Senate. You look at regulatory reforms, and again, these were things that President Obama basically did through executive orders, because he knew he couldn't even get Democrats to support these things if it went into legislation. So I believe a lot of these regulatory reforms will pass. Again, you've got a majority House and Senate that is controlled by Republicans, and so it's very hard for me to see. I can see a lot of foreign policy problems. I can see some trade problems. But with the key things that are going to drive the GDP in the United States, infrastructure spending, regulatory reform, and tax reform, I don't think there's a lot of disagreement that that's going to pass in one form or another.
All right, so you're confident that we're going to get, or the soon-to-be President Trump is going to get enough legislative backing in the votes to make it happen for the domestic economy. That's good. But is this necessarily going to happen without blowing out both deficits?
Well, if look, we have a $20 trillion deficit now. They're talking about adding $1 trillion in infrastructure spending, which probably only 800 million or billion of that will actually be in bonds that would add to the deficit. It's like 4 or 5% adding to the deficit. But unlike the trillions of dollars we've spent over the last 10 years in places like Afghanistan and Iraq and Syria, this money's coming to the United States. It's going to create 3.3 million jobs every year for the next 10 years. And so I guess it was Moody's who said that the infrastructure spending alone would create about $4 trillion in productivity increases over 10 years, that just the salaries alone for those 3.3 million workers would create a 0.5% GDP gain. And so all of these things combined, I think it's something we're going to be doing these bonds, infrastructure bonds, probably 50-year infrastructure bonds at the lowest rate that anybody's seen in a long time. Everyone knows we're going to pay them off with dollars 50 years from now that are not going to be worth the same as dollars are today.
Indeed.
And you look at the people in Japan and Germany who have negative interest rates, who are paying their banks to hold their institutional money, and this is going to look pretty good to them.
Okay. All right, Paul, listen, stay right there. A lot more talking about. Paul Dietrich from Fairfax Global Markets. Get back to him in just a little bit. Meantime, across in Europe, German with Paul Dietrich, Fairfax Global Markets, live out of New York. Paul, you were talking about how optimistic you were that Trump's policies are going to juice this economy, leading to possibly almost double the rate of growth that we have now, 2 to maybe 3.5, possibly 4%, without blowing out the deficits, without stoking inflation. It sounds almost too good to be true. But look, be that as it may, let me ask you, the market, what it does, and we were talking about this offline a couple of seconds ago, it prices in potential future growth, right, 9, 12 months down the road. If the implementation of these Trump policies, assuming they do pass Congress, is a 2018 story, is the market about right, or is it getting a little ahead of itself in terms of timing?
Oh, I think it has more room to run. And again, I do think we're going to have inflation over the next 10 years. But it's, again, the deficit that they're talking about is like 5% of the deficit that we have now. So it's not something that's going to break the bank. And all this money is going to be filtering through the U.S. economy. There is no question that the stock market is a forward-looking economic indicator. And so it's looking forward right now. So it is priced, some of the anticipation is priced in, but not all of it. That's for certain. And I think the next 2 years are going to be good because it's going to take a while for this infrastructure spending to really get into place. And I think the market will be anticipating it. The market will be going up. And yet the Federal Reserve, which has to raise interest rates based on real inflation, which I don't think you're going to see until the spending really starts kicking in, I think we're only going to see 2 Fed rate raises next year. They're going to be quarter points each. It'll be nothing. And so this is really good news for the next 2 years, 2017 and 2018, in the U.S. stock market.
Okay, meantime, though, you've got a market dealing with, until we see actual details and execution, implementation of these Trump stimulative policies, whether it's the infrastructure spend or tax cuts or deregulation, et cetera. This is a market contending with strong dollar. It's just barely getting out of an earnings recession, and you've got rates being jacked up extremely fast in a very short period of time. I mean, are those factors going to take the market down before it even has a chance to fully price in all this Trump optimism?
Yeah, but I disagree with you. We haven't had a Federal Reserve raising rates in record. We had 1 rate increase this year. I think I think most analysts believe we're only going to have 2 next year. That's hardly something terrible, and I think that's already priced into the market. As I said earlier, I don't believe that any political analysts down in Washington, D.C. Believe that it's going to be difficult to get these regulatory tax reforms, and certainly not the infrastructure spending, which has wide bipartisan support. And I think that's because most analysts believe that. That's why you're seeing this kind of bull market at the moment.
Okay, I mean, look, Paul, real quickly before we let you go, assuming you're right, I mean, all sounds good, but the 2 big ifs you talked about a couple of minutes ago, and these are really the gorillas in the room that nobody really wants to or likes to talk about. What happens when we do get trade protectionism? What happens when things kind of go sour in terms of bilateral or foreign relations with, name a country, pick one. What happens then? Because, I mean, the U.S. is a big enough and open enough economy that all this is going to blow back onto the real economy as well as the market, whether we like it or not.
I think the press has misconstrued some of Trump's trade policies. He's against multilateral trade agreements. But in my conversations with people on the Trump transition team, they are going to immediately start going after unilateral trade agreements. And we're in always a much stronger position as America dealing with Vietnam or the Philippines or any other country.
Hold on. You mean bilateral, right? I mean, not unilateral.
I'm sorry, bilateral.
Yeah,
bilateral. Okay. I'm sorry, bilateral trade agreements. And what's happened under the Obama administration is that we've given up what we've given up things that help our workers in order to get labor reforms and human rights reforms into those trade agreements. And to be perfectly honest, I don't think Trump cares about any of those issues. He only cares about what's going to help American workers. And so I think you're going to see a very different type of trade agreement. But, you know, if you're a worker in America, you're going to like it far better. And these agreements are going to be far more leaning toward benefiting the United States than the multilateral trade agreements. And so it's not that we're not going to have trade agreements. We are. And I think bilateral trade agreements are by far the better way to go. And I think most other people do, too.
All right. Listen, Paul, very useful talking to you. Thank you for the time. Happy holidays. We'll talk to you again soon, hopefully early next year. Paul Dietrich there, Fairfax Global Markets across in New York. Still